Hello ladies and gentlemen, in today's video I'm going to be explaining the worst types of iFVG setups, aka like pattern trading, and how to basically avoid these so you don't get stopped out. So these setups, I like to call them joker setups. Like, they look like A+ setups, but they fool you because the number one thing that we want to be looking at in trading is drawn liquidity. Right, so you can see a really good V-shaped recovery setup, but it'll still fail, and you'd be asking yourself, why did this fail? We had momentum, we had delivery, we had liquidity sweep, but it still fails, right? So we have to ask ourselves, why do some setups fail even though they look really, really good? So for the example, the first type of setup that I see fail are conflicting draws. So conflicting draw setups are definitely a big one. It's usually when I see price basically create a draw on liquidity on both sides of the market, or at least one draw on liquidity on one side, and then you're targeting the wrong side of draw on liquidity. For example, this is FOMC, right, at 2 p.m. EST Standard Time, right, Eastern Standard Time. We created this data high, and I saw a lot of people lose on this 5-minute short. So if we look at this short, right, we ask ourselves, is this like a decent setup, right? We have delivery, we have momentum, we have a decent target, right? We have a pretty standard sell side low here, good momentum. You take this short here off the close, stop loss, close above, target the low, right, for a 1-to-1, and you get absolutely destroyed, right? Okay. So why does this setup lose, right? We have to ask ourselves, right, number one thing is drawn liquidity. Up here, we have what? We have a data high. And if we know anything about data high, data low, right, which comes out from news, right? Usually 8:30 news, but for this example, it came out at 2 p.m. because we had FOMC, right? Price right now, its drawn liquidity is this data high, right? Because this is a very strong drawn liquidity in the market, and this data high is not really like a protected data high. Sometimes data wicks will maybe take out a bunch of liquidity, like this wick will come up and take out all these highs and then hard reject. But taking the first inverse down, just targeting a normal low while we have data high above, is not really that smart. You'd want to see a lot more bear structure here before you start targeting sell side draws, right? These lows definitely do look pretty good, right? These are pretty low resistant lows, but again, we're in that bullish market, all-time highs. So if we put in a data high or data low in, and you take a conflicting setup, meaning this is the draw on liquidity, but you're taking the opposite, even though it looks good, it most likely will fail, right? We have to see more structure before we start targeting sell side draws. So this setup fails, and obviously the draw on liquidity goes to data high. Now, once you take out the data high, this is where you could probably be looking for setups, right? Short setups, because now you've removed that draw on liquidity, that data low setup, data high as a conflicting draw. And in this case scenario, there's not really like a good inversion for value gap setup to the downside, but you can see how we get a bearish reaction up here, and then we do get some movement to the downside. So this one, take note of conflicting draws. Definitely a huge issue I see in a lot of traders is that they take setups where you get an inversion, but you're just targeting the wrong draw on liquidity, or you have two good draws on liquidity. And when you have two good draws on liquidity in the market, you want to wait for one side to get swept and then target the other. Okay, next example is just blatantly targeting high resistant highs, right? So if you know anything about high resistant liquidity, right, we have protected highs. So protected highs. So for a protected high, you'd basically have a high that sweeps out another high inside of a fair value gap, right? So I'm going to mark this out as high resistant liquidity, right? This high right here swept out these highs to the left. So price swept out these highs off market open, right? So if you know anything about market open, it has a couple of personalities. When market open manipulates, takes out buy side, rejects down, usually that's accumulation, manipulation to the upside to take out liquidity, and then you expect distribution, right? So now targeting this high, which this 931 high, which is not even a 930 wick, so in that case is not even that good of a draw on liquidity. You're now targeting a high that just swept out a bunch of other liquidity and rejected from it, right? So this high is not going to have as many orders as this high, right? Before, these were like low resistant highs, right? Think about this high, this high, this high. These were more low resistant highs because they haven't taken out a bunch of liquidity. But at market open, when you take out all of that liquidity, this is not that good of a drawn liquidity to target unless we take out major sell side. Maybe if we come down, take out like these lows, for example, then I'd be looking to retarget buy side. But because we come back down, all we do is take out a little bit of sell side. We do get that V shape up, right? We get that A plus like V shape right back up. Decent close on the candle, could be better, but you take this setup, right? You take this long, and you just get absolutely smoked on it. A lot of people lost in this play. So you target that high, right? Stop loss below, take profit at 1-to-1 at the high, and you get stopped out, right? So we have to ask ourselves, what is the number one thing in trading, right? Drawn liquidity. Drawn liquidity here is just not good. So protected highs, coming back to this is technically not a protected high. It's more of just a high resistant high. A protected high is a high. So it's a high that sweeps out another high. Let me use a different color. Yeah. It's a high that sweeps out another high inside of a fair value gap. So let's say, for example, to the left, there's a fair value gap right here, right? Price sweeping out this high inside of a fair value gap and holding the fair value gap. This is now a protected high, which is not a good drawn liquidity. You do not want to just start relonging to this because this will most likely end up rejecting and continuing lower. The only way now you retarget a protected high is after we take out major sell side liquidity, right? Which example for here, I don't think we took out enough sell side and we didn't go low enough. So that's why this long failed and that's why I faded it, right? So you want to be able to be targeting low resistant liquidity and try to avoid targeting high resistant highs, just like this one, right? Again, low resistant liquidity, trending lows, trending highs, right? Where we can get a Judah swing up, V-shape down, inversion for value gap right here, and then you can target all of this lows, right? You don't want to be targeting setups like this where you're targeting a low that just swept out other sell side, especially in a fair value gap, making this protected, because now this low is high resistant and there's not as many orders as there was with this low, right? Because now think about it, if price just took out all this liquidity here, there's not going to be as many orders as there was. So now this target is just blatantly worse. So this will most likely fail. So yeah, so those are the main two setups that I would definitely be looking out, especially when trading inversion for value gaps. Even any other model this kind of goes in the same play. Any other ICT model like 2022 model, breaker, like unicorn model, all of that. When you're targeting high resistant liquidity, most likely it's going to fail, right? So make sure to keep this in mind. If you like this video, subscribe, comment down below if you have any thoughts, right, or any advice or anything you want to see in the videos in the future, any questions. But yeah, make sure to note these down, and I will see you in the next one.